The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, good afternoon, folks. I started the show today by posting a chart of the Russell 2000, the IWM, which is the ETF for the Russell. And as you can see from that chart, we're making a 61% retracement of the move down as we speak. In fact, we've already made that. It's backed off just a little bit, but not enough to really count very much. The next chart that I posted into Tiger TV comes from a very dear friend across the pond that does some of the best technical work. Well, it is the best technical work I've ever seen, but he wanted to alert me to the fact that yesterday on the S&P, when we hit that 2002 level, 202 on the cash, that it was an exact ABCD from the low in 1987. That's when the Dow hit 1666 right after the crash on October the 19th. The next day it bottomed slightly lower, point or two in the Dow. That was a 61% retracement of the low from August the 9th, 1982. So that 87 low was a 61% retracement of that. And if you take the ABCD starting in 1987, which was the crash low, and you can see the ABC very clearly on the chart, the D level completed yesterday at the 202 level. So it's going to be quite interesting here, where we are, because these are patterns. I don't know too much about the well, that's the understatement of the year. I don't follow the fundamentals. I don't understand them, and I don't want to understand them because they're too confusing for me. One time it's bullish, the other time it's bearish, but if you focus on what the bar charts are doing, gives you a little bit of an edge that I find is the only edge that I can find that really tells you where you are. Because if there's more buying, prices will go up. If there's more selling, prices will go down. That's the bottom line. And we've had more buying than selling recently, and that's why prices have gone up. There's been a lot of talk about the volume. I don't understand volume that well. All I know is it's highly unusual for the market to get this high with very, very low volume. That tells me that there's not many players in there. And where did this $29 trillion of buying that occurred, recently, what was going to happen, what would really be the thing that would cause the market to go up. So whether that's going to happen or not, one has to wait and see. But we'll wait and see. There is someone asked a question about the 5-point reverse wave. There certainly is that, and I'm going to focus on that just a little bit. But I wanted to spend just a tiny bit more time on this time frame that we're looking at here, from 1987 to where we are right now, because we need to look at what happened in 2008. Because the market, if you remember, it topped in early August, and then it came down into August 15th on a very hard down move into August 15th. That was one of the only 2 days that Skype has ever been out. And I remember that very vividly because Tom O'Brien and I were chatting about this, and I was in Las Vegas for a conference, and Skype was out, and boy, really put a crimp in the communication. However, that low that we had on August 15th, the market then went up for 5.5 weeks, and it topped on October the 14th, which was also a new moon like we had on Monday. And then it, started down and gave back more than 50% of its value over the next 18 months. Now, whether that's going to happen or not, again, I don't know, but history has a tendency to repeat itself, over and over again. So we want to keep that in mind. Now, I wanted to talk just briefly about the Bradley model here, because I get so many questions about it. People think that it's a perfect indicator, and boy, folks, let me tell you, there is no perfect indicator. And this is one that does a good job, but it's not perfect. And what we're looking at here is what happened in 2008. We had, you see, the Bradley model was pointing down all during that time, but you can see that there were periods there where it really didn't follow as well as you might think, but the overall pattern, had you moving to the downside. Now, the fact that we made a higher high in the Dow here and the NASDAQ and the S&P does not concern me too much, because that's what happened in 2007, in October of 2007 when we did that. And the market started down, and the Bradley model was spot on at that time, saying that we were getting ready to go lower. So we're in a close area. Now, we have not made a higher high in the New York Stock Exchange Index yet. That really surprises me, because with this last thrust that we've had here, it is very surprising to me that we're unable to make a new high in the New York Stock Exchange Index. Whether we will, in the next day or today, tomorrow, the next day, will be, I think, rather important, because if we don't, this is going to tell us that we are looking at a major double top in here on this NYSE index. We know that when we came down into early August, that was an incredible buying opportunity, because we were right at a 61% retracement and right at a 382 retracement off the February low. And remember now, the Dow has gone above the high of July the 3rd, as has the NASDAQ, is at the 1.618 expansion of that. The S&P is almost at the 1.27 of that level. The IWM, the Russell, is at the 61% retracement. And we've not made new highs in the transportations nor the utility index as yet either. So there's some divergences that are showing up, but they're still relatively minor considering what we're looking at here. Now, we had a question from one of our folks in the Tiger Den about the S&P index on a long-term basis, and I wanted to put that up because I had done it earlier, and I wanted to make sure that we'd be able to see it. So all I have to do is put the little toggles in, and you'll be able to see this 5-point reverse wave that we have moving in right now. Now, the low that you're seeing on this chart right here is the low from 1994. That's when we had Mr. Greenspan was starting his move to lower interest rates. And, that market went up, and that was part of the internet bubble. And if we look at the internet bubble from 98 through 2000, that 2-year period when everything was crazy, folks, that looks like nothing compared to what we have going on now. I mean, it really doesn't. I mean, you stop it, and believe me, that was really a once-in-a-lifetime thing when we were looking at 2000, because it was the NASDAQ. It wasn't really the S&P. The NASDAQ was basically a vertical market. So I really shouldn't say that, because it's totally different. In fact, I should do that right now just to show you the difference between what happened. Well, you guys know this, but history is always good, because if you don't study history, you're bound to repeat it. So we just need to take a look at it here, and you'll see, it gives a prediction of where the market's going. Son of a gun, this is really interesting. This will be the first time that you'll see a prediction on the charts, folks. Bear with me here a second. Wow, this would be a good chance for you to get in. That big red bar you see on the right-hand side is a bad tick. What's interesting is that we did make the 786 retracement up here this week at the 4070 level in the NASDAQ futures. We're trading right near that level right now, as a matter of fact, but that is the 786. But as you can see, from 1998 to 2000, the market went from roughly 1,000 to 5,000, 4 times the size of the move, and we only went twice as much in the regular stock market. But that was the internet bubble, when these little companies didn't have any earnings or absolutely anything, and yet they would open 30, 40, 50, 100% higher. And it was really in a time that I'll never see in my lifetime. You folks probably will. The young folks will anyway. But that's what we're looking at in the NASDAQ and what it really did. So we do have the 5-point reverse wave that is completed. That's why it's really hard for me to be bullish up here, because this is just really long-term stuff. Much like when we were looking at the bottom in March of 2009, that was very long-term. work. We were right at the 786 of the 94 low. We were at the 618 of the 82 low. I mean, all those numbers were coming together, and now what we're doing is we're seeing the exact opposite on the upside, and you can't get anyone in the world to listen to you. And boy, that's when I know that it's clear that the path of least resistance will most probably be down when it finally does start down. Whether it'll be in my lifetime or not, we'll have to wait and see. It's important to me technically that we don't take out that high we made yesterday, because that was within 1 day of the new moon, and it usually has a 1 or 2 day orb. We also had that Venus-Uranus day that came in, and it looked like it was going to be one of those come-to-Jesus moments where the market was going to go up forever, but it did stop and started to roll over a little bit to the downside. So that's something that I think is important for me from a technical point of, because of the fact that these cycles, when they do work, boy, they're spot on. They really don't give you much leeway as far as being able to you don't have to wait very long. I mean, they're either going to work right away, or it's just, it's just going to be one of those trades that just doesn't work out. So we have to keep a close eye on the high that we made this week. It'll be very important. Another question, someone from dropped me an email last night regarding the VIX index, why the VIX index hasn't gone to new low ground with the high in the stock market. And there are two different things. One, they're measuring two different things. One is measuring the stocks themselves, whereas the VIX index is measuring the volatility of what the market's doing. And we're still setting right at the 786 on this VIX index. We really are. We're right at the spot where we were just a few days ago at 1170. We got a caller coming in. I think it's almost at the break time, and it's Brent from California. Brent, are you there?
I am, Larry. How are you today?
I am good. What can I help you with, my friend? By the way, stay with us if the break comes, because we can talk after the break. So go ahead and ask me the question.
Sure thing. I just wanted to comment and say I think you've got, out of all the hosts, about the best intro music, with a little bit of Elvis and a little bit of surf music. I like it. It has some rhythm to it, a little energy to it.
Definitely not elevator music.
No,
I like any kind of music as long as it's country or western.
Yeah, I like it. Good stuff.
Okay, what can I help you with, my friend?
I want to get your thoughts on gold and silver, if I could, please.
Oh, the silver one is a real easy one, because we are spot on here, where we setting right at the 786 in silver right now. I've been watching it all morning, and it's just a question of whether we are going to hold this level. Stay with us till after the break, okay, Brent? And then we'll talk about silver and gold together.
All right.
You bet.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Thinkorswim, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
Andy Hecht's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and we're speaking with our friend Brent in California. Are you still there, my friend?
I am. Thank you, Larry.
Okay, I've posted into Tiger TV the daily chart of silver. And if you'll get a chance to take a look at it, you'll see that it's been at the 786 level down here around the $19.30 per ounce level for the past 5 days. It's been down there 5 times. Again, we took out the lows of yesterday by just a little bit, haven't really gone anywhere to the downside, so it's retested it again. So I think it's very, very important that it holds this level. Now, in cycle theory, Brent, if this is really a good cycle, it's going to come out of here really strong. I mean, a move of 50 cents or even $1 very, very quickly if this is a really good cycle low. So that's what I'm watching in silver right now. That 1920 level is very, very important. Now, you asked about gold, and so I posted the chart of the hourly chart on gold over the past several weeks, and as you can see, gold has made much higher bottoms, whereas silver has tested the bottom 4 times now. Gold is making higher bottoms, so that has a potential to be very, very constructive to the gold. So this is these are the factors that I'm watching. Now, one final thing that I wanted to bring to your attention is that if we look at both of them together, you'll see that the silver has been far weaker, which is what we've just been talking about. But it's finally starting to look like it has a chance to turn if it can stay above that $19.20. So, I mean, your risk here is around 20 cents, in my opinion, but it looks like it's got a chance. That's my bottom line in gold and silver.
Yeah, it seemed like they're both at fairly critical levels to hold, so I hope they do that. We'll see what happens.
Hope is not a very good trading.
You've told me that before. I've got that etched in my brain.
I can remember. I'll tell you a funny story. This was back in '74 when I was living in Westlake Village, and I was stuck in a weak position, and I just, I'd really done everything wrong in my account that you could possibly do, and I used to walk around the lake all the time, and when I was about halfway around, I saw this beautiful home up on the hill, and I said, if I can work myself out of this position, I'm going to buy that home. And well, I probably could have worked there maybe as a chauffeur, but I certainly couldn't have bought the home because they got me in October of '74. So hope is not hope and pray are not very good trading tactics, my friend.
Not at all. No, and I agree. I have my stop right there below where the area you're talking about. So.
Yeah, that's the safest way to do it because we don't know what's going to happen next, but nobody else does either. So that's the big advantage that we have.
Well, don't ever stop telling your stories. I love to hear them, and it's always entertaining. You do a great job of telling them.
That's a function of old age, my friend.
I wish there was a lot more people out there like you. The world would be a better place for sure. So.
Yeah, I've been very fortunate with this career that I started many, many years ago. I've enjoyed it very, very much. There's several different paths. I'm going to be writing my autobiography soon. And back in 1982, I had a chance to go into the hedge fund business full-time with a big hedge fund out of Chicago. And I decided to become a floor trader at the Merck instead, which was a big change for me. But I wouldn't have had the same experiences, so I have no regrets at all. I mean, I really, I've had so few things go wrong in my 74 years that it's just been pretty good. There's been a few of them, but those are just normal things of losing friends and stuff. And in fact, I lost a good friend on Monday, my good buddy from high school, Buckwheat. He finally passed away of Alzheimer's at the age of 74. I couldn't believe that's what he died from, but it's very sad. He was best man at my wedding, and it was a rather sad situation, but that's all part of old age. Okay, now we want to go back to talk about this VIX index. Oh, Brent, I didn't know you were still on, my friend. Oh, my gosh, sorry.
I was listening to okay. I love hearing
call
you
me
talk.
up. Call me up, and you don't have to get on the radio show. Call me here at the office. I'm usually not that busy, so.
Anyway, take care.
You bet, my friend.
All right, bye-bye.
You bet. I think where Brent lives is right in the cattle country of Central California, as I recall. But anyway, the VIX index, the fact that it didn't collapse and go down to that 10.5 or 11 area and it stayed above the 1170 for most of the time during this last 3-day run-up is really an amazing feat, in my opinion. So we're starting to see some divergence across the market. We still got the Dow up a bit, and NASDAQ is up, S&P's about unchanged, and gold's down a bit.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com, educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, we're back, and I've posted the chart of November soybeans in here because we are completing a big pattern here, and we've got tremendously bearish news out there. As you know, we're having huge crops, but this is a big pattern. As you remember, about a week ago, we were making the 1.27 three-drive pattern, and the market rallied about $1,500 after that low was in, and now we've come down and we've made the 1.618 level down here at the $10.18 a bushel level. So we're watching soybeans very, very closely today. I will show you what I was doing this morning, was watching to see how the market was going to react because we had some really quick moves to the downside, and all I was doing was watching the long bars, and I was waiting for some formation to hit where we had the long bars had stopped, and they stopped around the 786 pretty much where it's trading right now. Well, the risk on this particular trade would be about 8 cents, which is $400. So becoming a soybean farmer for $400 is actually not a pretty good deal. Whether it's going to work or not remains to be seen, but that's what I was doing to try to quantify the risk because this level at 10.19 per bushel should be pretty strong resistance support. In my opinion, that's what it looks like to me. Now, I have to share something with you that most of you folks don't trade the DAX index, which is the German equivalent of the S&P, but you have to see this because this is really an incredible technical chart. It is spot on as far as the type of things that we're looking at. But the reason why I want to share this with you is for two reasons. One is we are setting exactly at the 61% retracement of the high that it made way back in July before it dropped 12%. It went from 10,070 down to 8,900, and now we've rallied back to the 61% retracement. And to the exact tick, by the way, I mean, it hit it right at the number 9,600, and the high today was 9,602. But the real interesting part is if you were watching this today, you'll see that I'll put this up so you'll be able to take a look at it. When it was making the high up there at that fib number, when the market was not quite open here in the U.S., you'll see that we were making a 3 drive to a top pattern on that 5-minute chart. And that took over a day and a half to form. So each high was exactly 1.19 higher than the previous high, so it really didn't go anywhere, and then the market proceeded to break about 70 points. Now, if it goes and closes above 9,600, this will tell you that this pattern is certainly no good, but right now it's telling you with a relatively good degree of accuracy that we've made some type of a pretty major high in the DAX index. Now, if you'll take a look at that hourly chart that we were just looking at. I'm going to put it up again because I think it's important. I remember this like it was yesterday, but this was it was on August the 8th, and happens to be my daughter's birthday, and it was I was up almost the whole night because it was my turn to trade all night, and we were having a 3 drive to a bottom pattern forming in the DAX index. We were making that 382 and 61% retracement in the S&P when it was trading at 1890. It got down to 1889 before it turned, and that was the turning point. And then the market, exploded to the upside and has gone straight up, since that August 7th date. Now with the DAX, you can see there's been some up and down move along the way, but not so with the NASDAQ and the S&P. Those have been basically just straight up because they've been the stronger of the patterns. But I think it's important to watch this. By the way, if you folks trade, early morning New York time, the DAX is much easier to trade than the S&P 500. It doesn't have those herky-jerky moves of 2 or 3 points. It trades pretty much spot on to the fib numbers and hits the patterns much better than the S&P. Why, I don't know, because it's just a fraction of the S&P volume, but it trades good volume. I mean, you can easily put your trades on without any trouble at all, but it's not nearly as big as the E-mini S&P. But there is a little bit of a herky-jerky, mainly probably because of the reports that we get here in the U.S. They get them in Germany too, but they just don't react to them the same way. So it's interesting that we're at that exact 61% retracement. At the same time, we're hitting some real serious spots in the in our stock index futures. So it's important. I don't really. The question that has been posed to me: why hasn't the New York Stock Exchange Index been able to make new highs? I don't know the answer to that. I mean, we're still at more than 100 and some points away in that index, but it's the real market. So this could be a potential double top, that we're having. Back in 2008 when we were making it, well, it was October of 2007 when we were making our high there on the 14th, everything was going up. We had new highs in the NASDAQ, and we had new highs in the S&P, new highs in NYSE, all of that. And it looked like another big breakout, and that lasted about 3 days, and then down she went. So just be careful up in here. We got a lot of numbers that are still playable. The market hasn't really done very much. It's still going up, but it's up 4% in August, which is a very, very unusual event. That's an outlier event in itself. And September and October are the 2 most negative months of the year historically, going back since they started trading back in 1792, I think, is when they did the first trade under the buttonwood tree in New York. But September and October by far are statistically the most negative months of the year, and the Bradley model is certainly pointing down, but it could be wrong. It's certainly not perfect. As I showed you on that 2008 chart, it gave a pretty good idea of what the trend was, and the trading dates were pretty good, but unless you had the patterns lined up together with you, it had been really difficult unless you had nerves of steel and very deep pockets to stay in there when you had those huge rallies that we had when it was on its way down. So we're going to be interesting to see what's happened. There's a complacency on Wall Street like I haven't seen in a very long time. Everybody is set to buy any break, and that might be the right thing to do, but Bernard Baruch has always said in his autobiography, My Own Story, he said that the greatest scam in Wall Street is to inflate something to a high price. He says you can get suckers to buy it all the way down. And I'm sure that that's true because I see it in a lot of other things, not just in, just in the stock market. Look what's happened to cattle. And it happened to hogs. And, of course, hogs have given back more than 25% of their gain, recently. So these things do turn around. Isaac Newton's law has not been repealed as yet. What goes up must come down. For every action, there's an equal but opposite reaction. So we'll see if it's going to happen this time or not. But we'll keep an eye on it anyway. But just be really careful up in here, folks. As bullish as it looks, fundamentally, there are some technical things that absolutely scare this old cowboy to death, and it's not a small thing either. I remember those of you who've been following us here at TFNN for a long time, how bullish I was on March the 5th of 2009 because of all those numbers that we had coming together. The Bradley model was making a bottom on that day. March 5th, 2009, and boy, everything was set that you didn't have to wait very long to see if you were right. And of course, at that time I called it the point of no return, and I said it'll be the biggest short covering rally in at least the last 70 or 80 years in the stock market. And it broke all-time records. As you know, we've gone up to new highs far, far higher than this old boy thought it would ever get. So we'll see what the next stage brings here, and we'll take a look at it from that level. Now, another question that someone has asked me is, what is the relationship between crude oil and the stock market? Folks, I can overlay crude oil over the stock market, and you can't see any correlation there at all to make any sense of it at all. You really can't. You can do the same thing with the euro. You can do the same thing with gold, but there's not much of a correlation there. Yes, there are times when they go up because they go up together with, whether that's just small cycles bottoming or not, I don't know. But longer term, it's really hard to make that analogy. Even if you do stocks and bonds over a long period of time, you don't run into a really good correlation. So that's the main thing that you want to keep in mind. The best correlation that I have ever seen in the market is the dollar versus the Japanese yen and the Nikkei Dow. That has a better than 95% correlation. When the Nikkei Dow goes up, the Japanese yen goes up. And, so those are correlations. I don't trade those correlations, but I watch them just to see what happens. Remember, for many years, we had copper was heavily correlated to the stock market, yet the stocks kept going up for 2 years, and copper went straight down. It went from 415 to 260, I believe, as the stocks kept making new highs. So the correlation completely disappeared during that time. So you have to trade what you see and not what you believe. That much I believe 100%, because you never know what's going to happen next. And you don't know how much you're going to make on a trade. So the only thing you can do is to protect your backside, by using some money management and stop protection. And believe me, folks, stops are there for your protection. So try to use them if you can, because they are very, very important. Someone's asked a question about the reason why I get emails from folks and they ask me questions about some of these things, so I try to answer them when I'm on the air here. We're going to take a look here at the transportation here because it looks very similar to the New York Stock Exchange Index because it has not been able to make new highs. Back in the old days when divergences actually counted, this was a known as a Dow theory signal where the transportations were not making new highs, the utilities were not making new highs, but the industrials were, and that was telling you that there was weakness coming in the market. This was work that was done by Richard Russell from the Dow theory forecast. He's the one who knows more about that than anybody, and he certainly has been around for a long time. He's almost 90. I believe he is 90 now, and it's really a really interesting one to watch. Now, I think if you like technical analysis, this next chart you should really like because this is the Dow Jones Utility Index, and as you can see, we're making a perfect head and shoulders pattern here, folks, and this is a perfect head and shoulders pattern for three reasons. First of all, you can see the symmetry between the left shoulder, the high, and the right shoulder. That's one reason, okay? Now, the second reason is the time from the left shoulder to the right shoulder is exactly equal. And the third thing is that the retracement back into the right shoulder where we were just 3 days ago, was an exact 61% retracement of that high. And if you go back to see where the left shoulder was back on April the 30th, it was at the same price, $555. So that makes a perfectly symmetrical pattern in the Dow Jones Utilities. I mean, it cannot be any more perfect than that. That's a perfect definition of a head and shoulders pattern. So it's very simple now. If we get above 562, we're trading at 555.30 right now. If we get above 562, that would take out last week's highs, this week's highs, and it would look like the market was going to be taking another leg up, and it would destroy this beautiful symmetry that we have on this head and shoulders pattern. So that's the moment of truth. You just know exactly what your risk is here, and your profit objective is at least 5 times what your risk is. So it's a very interesting pattern, but it is a perfect head and shoulders pattern. If you flipped it upside down, you'd have a head and shoulders bottom, but this one happens to be the head and shoulders top with absolute perfect symmetry. Now I wanted to go back and take a look at the Russell, because I've had someone's asked a question about the importance of the 61% retracement. And, it's like any other of the Fibonacci numbers. Some of them are work and some of them don't. If you'll take a look at this one, though, on the Russell, on the way down on the Russell, we stopped exactly at the 61% retracement. We rallied for 2 weeks, and then we came down and made our final bottom at the exact 786. And now we've rallied up to the 61% retracement. So this market is, still much weaker than the rest of the market. Now we've taken out yesterday's high by a little bit, and now we're trading a tad lower, but that's still too early in the day. Now there's no head and shoulders pattern in this Russell index. There really isn't. You could try to force one, but that's not what you're supposed to do. They're supposed to be able to jump right out at you. And this one doesn't. All this one is, it's a retracement back to a 61% retracement of the high we made on July 3rd. We came down to the 786, up to the 618. Now we should be heading down. Okay, we've got the Dow up, gold down, and silver still down a bit. We'll be right back.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Okay, folks, the next chart we're going to take a look at comes from our friend in Germany, Mr. Andy, and it shows the hourly chart on the Treasury bonds and the fact that we're getting ready to make a 3-drive pattern up here at the 786 level, just above the 141 level. In the bonds. We're not too far away from that spot. So it's telling us that if we get there, that would be a very low risk trading opportunity, because it would be completing that 3-drive pattern and also making that 786 retracement, and that would complete a Gartley pattern because the market is still in a downtrend as we're making lower tops. If we take a look at the Treasury notes, you'll see a much different picture, because this market is far, far weaker than the long-term bonds. In other words, the rate, the notes, the interest rates on the notes drop farther down than they did on the bonds, and that's what they should do, usually, unless it's really crazy, and then the notes will get higher in interest rates as safety goes to the forefront, but so far that has not happened as of yet. So the notes are still in a bearish trend. It made the 786 last week up there at that 127 level. We came down to 125.5, and now we're rallying back to the 61% retracement of that level. So it's important, I think, to take a look at these, because it's a big technically these markets are so much bigger than the ones that we have with the stock market. It's hundreds of times bigger than the other ones. So keep in mind that that's what we're watching. One other thing I wanted to mention before we leave you here is that the dollar index is still up at this 81.75 level. It's been here for 4 or 5 days. The euro got down below the 132 level, got down to 131.60, I believe, last night. But it's trying to find a bottom in here, as is the British pound at around the 165 level. The yen is looking for a top up here at this 84 level. So we have to keep a very close eye on this, because we've completed this big ABCD in this dollar index, and the CD leg is 1.618 of the AD leg. And if it explodes above 83, there's going to be something rotten in Denmark. And I love Denmark, but there's going to be a problem somewhere in one of these markets, because the dollar is going to get very, very strong, and that means that the worst benefactor of this, or malefactor of it, would be the euro, because it's 53% of the dollar index. So if this euro collapses below 131, you're going to see the dollar index take off like a rabbit running from the fox. So watch the dollar index at that 82.80 level, which has been the high thus far, because it's a really critical level in the dollar index. Very, very similar to what we had when the yen was down around 75, when Tom O'Brien was talking about King Dollar, and it went from 75 to 105 in a matter of 7 months. So whether we get another move like that or not, we'll have to wait and see. But we will be getting increased volatility in the stock market. The VIX index has already told us that. It had a 70% move off the bottom. It's backed off 78% of that. So people are aware that there's something is happening. They don't know what it is yet, and I don't either. So, but something is happening, and it will come to the forefront, relatively shortly, and we'll have some increased volatility, which is what we really want. These 5 and 6 point, 7 point days in the S&P just doesn't cut it for trading purposes. You need days where you have 25 and 30 points, where the Dow is up 100, down 100. So that's what we're watching. So live every day in an attitude of gratitude, folks, and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.